Hey everyone, and welcome back. Today, we're talking about a huge topic that can feel totally overwhelming: investing. Specifically, we're answering the question, if I were starting from scratch, with zero investments, in 2026, what would I do with my money? Maybe you've been putting it off, or the current market feels confusing. I get it. But whether you have $100 or $1,000 to start, the best time to invest was yesterday, and the next best time is today. I'm going to break down the first 3 steps you need to take. Then we'll cover the core strategy. And finally, the best investment vehicles for 2026. Let's get started. Welcome. Before we dive into the exciting world of stocks, bonds, and building wealth, we need to lay the essential groundwork. Think of building your financial life like constructing a house. You wouldn't start with the roof or the fancy windows, would you? No. You start with a deep, solid, unshakable foundation. Without it, the entire structure is at risk of collapsing at the first sign of a storm. Investing is the powerful engine for wealth creation, but it must be built upon a bedrock of financial stability. This initial phase isn't about chasing high returns. It's about building resilience. It's about creating a safety net that gives you the confidence and the security to invest for the long term, without being derailed by life's inevitable surprises. The most common analogy you'll hear is putting on your own oxygen mask before helping others. It's a cliché for a reason. It's fundamentally true. If you're in a state of financial panic because you can't cover an unexpected bill, you won't be able to make rational, long-term decisions about your investments. Instead, you'll be forced to react out of fear, often leading to costly mistakes. This groundwork is your oxygen. It allows you to breathe, to think clearly, and to navigate your financial journey from a position of strength, not desperation. So, what is the very first non-negotiable step? Your first money move is building an emergency fund. This is your personal financial firewall. The standard recommendation is to save 3 to 6 months' worth of essential living expenses. To figure out your number, sit down and calculate exactly what it costs you to live for 1 month. We're talking about the absolute necessities: your rent or mortgage, utilities, groceries, transportation, insurance, and minimum debt payments. Multiply that monthly total by 3, and that's your initial target. Once you hit that, aim for 6. This isn't just a pile of cash. It's a fully funded buffer between you and life's what-ifs: a sudden job loss, an unexpected medical bill, or a major car repair. Let's be crystal clear. This money is not for investing. It is not for a vacation, a down payment on a car, or for chasing a hot stock tip. Its job is singular: to be there, untouched, until a true emergency strikes. The goal here is not growth, but preservation and accessibility. So where should you keep it? The ideal home for your emergency fund is a high-yield savings account, or HISA. While not a traditional investment, HISAs are a game changer. They typically pay interest rates many times higher than what you'd get in a standard checking or savings account at a brick-and-mortar bank. This allows your emergency fund to at least keep pace with, or even slightly outrun, inflation, so it doesn't lose its purchasing power over time. Most importantly, these accounts keep your money safe, liquid, meaning you can access it quickly without penalty, and are typically FDIC insured up to $250,000. This means your cash is protected no matter what happens in the broader economy. The ultimate purpose of this fund is to prevent you from being forced to sell your long-term investments at the worst possible time. Imagine the market is down 20%, and suddenly your transmission fails. Without an emergency fund, you might have to sell your stocks at a significant loss to cover the repair bill, locking in those losses forever. With an emergency fund, you simply pay for the repair with your cash reserves and leave your investments untouched, allowing them the time they need to recover and grow. It's your ultimate defense. Now, let's talk about the second pillar of your foundation: high-interest debt. If you have credit card debt, payday loans, or high-interest personal loans, typically anything with an interest rate over 7 or 8%, your primary focus, alongside building a small starter emergency fund of, say, $1,000, should be on aggressively paying those down. This kind of debt is a financial anchor, actively pulling you backward and canceling out any potential investment gains. Why is this so critical? The math is simple and unforgiving. If your credit card charges you 20% interest per year, and the historical average return of the stock market is around 8 to 10%, you are fighting a losing battle by trying to invest. For every dollar you earn in the market, you're losing 2 on your debt. You are effectively digging a hole while trying to build a ladder. But here's the powerful part. Paying off a debt with a 20% interest rate is the equivalent of earning a guaranteed, risk-free 20% return on your money. You will not find that kind of guaranteed return anywhere in the investment world. Eliminating this debt is the single most powerful investment you can make. With your emergency fund in place and high-interest debt vanquished, we can now look to the future. The next critical question you must ask yourself is, what is my time horizon? In other words, how long will it be until you need this money? Your answer to this question will determine your entire investment strategy. We can break this down into 2 main categories. First, short-term goals, which are anything you plan to spend money on within the next 1 to 3 years, maybe up to 5. This could be a down payment for a house, a wedding, or a new car. For these goals, the priority is capital preservation. You cannot afford to risk this money in the stock market, which can be volatile in the short term. Instead, you should keep it safe in those same vehicles we discussed for your emergency fund: high-yield savings accounts, certificates of deposit, CDs, or high-quality short-term bonds. Then there are your long-term goals, anything 5 or more years away, with the most common example being retirement. This is the money that is truly meant for investing. The longer your time horizon, the more risk you can typically afford to take on. Why? Because you have decades to ride out the inevitable ups and downs of the market. A market downturn in your 20s or 30s isn't a catastrophe, it's a buying opportunity. Time is the most powerful ingredient in the recipe for compounding growth. It smooths out volatility and allows your money to work for you in a truly profound way. Understanding this distinction between short-term safety and long-term growth is the key to allocating your money effectively and sleeping well at night. My strategy is simple, powerful, and backed by decades of data. It's not a get-rich-quick scheme, but a get-rich-surely plan. It's a philosophy that has empowered millions of ordinary people to build extraordinary wealth, and it all starts with one man's revolutionary idea. This is the Boglehead philosophy, named after the late John Jack Bogle, the founder of Vanguard. Bogle wasn't just a businessman, he was a crusader for the individual investor. He believed the financial industry was designed to enrich itself, not its clients, through high fees, complex products, and a culture of speculation. His radical idea was to create a company owned by its funds, which in turn are owned by the investors. This structure ensures that the company's primary goal is to lower costs and maximize returns for you, the shareholder. In 1976, he launched the first ever index fund available to the public. It was initially mocked by Wall Street as Bogle's folly and un-American. They said no one would be content to just match the market average. But Bogle trusted in what he called the relentless rules of humble arithmetic, and history has proven him right. His entire philosophy, now embraced by millions of bogleheads worldwide, is elegantly built on 4 common-sense pillars. Let's explore each one. The first pillar is to start early and invest regularly. This is about harnessing the single most powerful force in finance, the magic of compounding interest. Compounding means your initial investment earns returns, and then those returns start earning their own returns, creating a snowball effect that grows exponentially over time. The most critical ingredient for this magic is time. Consider 2 investors. Sarah starts at age 25, investing $500 a month. Mark waits until he's 35 and invests double that, $1,000 a month, to try and catch up. Assuming a conservative 7% average annual return, by the time they both reach age 65, Sarah, who started earlier with less, will have over $1.3 million. Mark, despite investing the same total amount of money, will have only around $750,000. That extra decade gave Sarah's money an insurmountable head start. Starting now, even with a small amount, gives your money decades to grow exponentially. This is why timing the market is less important than time in the market. Trying to guess the market's peaks and valleys is a fool's errand. The key is consistent, disciplined investing, month after month, year after year. The second pillar is diversification. This is your primary defense against risk. You've heard the old adage, don't put all your eggs in one basket. In investing, this means you don't want to bet your future on the fortunes of a single company, or even a single industry. Even the most dominant companies can falter. You don't want to bet on a single company. You want to bet on the entire economy. So how do you easily and affordably buy the entire economy? Through index funds and ETFs. This is the core of the strategy. An index fund or exchange-traded fund, ETF, is a basket of hundreds, sometimes thousands, of stocks designed to mirror a specific market index. The most famous is a fund that tracks the S&P 500. By buying one share of an S&P 500 index fund, you instantly own tiny pieces of the 500 largest and most influential companies in the US. You own a piece of the tech giants, the healthcare innovators, the consumer brands, and the industrial powerhouses. You are diversified across every major sector of the American economy. If one company fails, it has a negligible impact on your overall portfolio. These funds are inherently low cost because they require minimal management. There's no highly paid manager trying to pick winning stocks. The fund simply buys and holds the stocks in the index. The goal is not to beat the market, but to match the market's return, which, historically, has been a fantastic way to build wealth over the long term. You are accepting the market's average return, which, thanks to fees and human error, is a return that most professional investors fail to achieve. This brings us to the third, and perhaps most overlooked pillar, minimize costs. Fees are a silent portfolio killer. They eat into your returns every single year, whether the market is up or down. Even a small difference in annual fees, like 1% versus 0.03%, can cost you hundreds of thousands of dollars over a lifetime. Think of it as a constant drag on your performance. A 1% fee on a $100,000 portfolio is $1,000 a year every year. Over 30 years with compounding, that seemingly small fee could reduce your final nest egg by nearly 30%. It's a massive, unnecessary wealth transfer from your pocket to the fund companies. This is why low-cost index funds are so effective. Their primary metric of success is how cheaply they can deliver the market's return to you. When you're choosing a fund, the most important number to look for is the expense ratio. This tells you the percentage of your investment that goes toward administrative and management costs each year. Look for funds with expense ratios below 0.10%. Many broad market index funds are now available for 0.05% or even less. Every dollar you don't pay in fees is a dollar that stays invested and working for you. Finally, we arrive at the fourth pillar, which is arguably the most difficult because it requires mastering your own emotions. Stay the course. The market will have bad days, bad weeks, and even bad years. It's a guarantee. There will be recessions, geopolitical crises, and moments of sheer panic. As the economy shifts in 2026 or any other year, your natural primal instinct will be to panic and sell when prices drop. Your brain will scream at you to do something to stop the losses. Don't. This is where the most wealth is destroyed. Selling in a panic locks in your losses and often means you miss the subsequent and often rapid recovery. True long-term investing means creating a plan and sticking to it. It means automating your investments so the money is invested every month without you having to think about it, and then ignoring the daily noise of financial news. You must reframe your thinking. Market downturns are not disasters. They are opportunities. They are sales. When the market drops 20%, it means the world's greatest companies are available at a 20% discount. Your automated investment is now buying more shares for the same amount of money. By staying the course and continuing to invest, you are setting yourself up for greater gains when the market inevitably recovers. This discipline, this emotional fortitude, is the final crucial piece of the Boglehead puzzle. Now let's talk about where to put your money and what to buy. Many beginners focus only on what to buy, which hot stock to pick. But successful investors know that you hold your investments is just as important. The type of account you use is the container in which your money will grow. Think of it like this. Your investments are seeds. A standard brokerage account is like planting a seed outdoors, exposed to taxes on gains every year. A tax-advantaged account, however, is like a greenhouse. It protects your investments from the harsh weather of taxes, allowing them to compound much more powerfully. This is a key step many beginners miss. Use tax-advantaged accounts first. So what's the first greenhouse to use? If your employer offers a 401k with a match, your first priority is to contribute enough to get the full match. This is the closest thing to a golden rule in personal finance. Why? Because it's free money, an instant guaranteed return you can't find anywhere else. If your company matches dollar for dollar up to 3% of your salary, that's an immediate 100% return. You are literally doubling your money. Failing to capture this match is like taking a portion of your paycheck and setting it on fire. Check your benefits paperwork. Find the matching formula and set up your payroll deduction to get every single free dollar they are offering. This is the single most impactful financial decision you can make today. Once you've secured your 401k match, an individual retirement account, or IRA, is your next powerful tool. You open this on your own at a brokerage firm. With a Roth IRA, you contribute post-tax money, and all your growth and withdrawals in retirement are 100% tax-free. With a traditional IRA, your contributions may be tax-deductible now, but you pay income tax on withdrawals in retirement. For most young investors, the Roth IRA is often the more powerful choice, as you pay taxes now while your rate is likely low, and avoid them later when your nest egg is larger. Okay, you've set up your accounts. Now for the big question. What do you actually buy? For a new investor, the pillars of a successful strategy are maximum diversification and radical simplicity. You don't need to be a stock-picking genius. You just need to own the market and keep costs low. My primary investments would be built on just 2 or 3 core funds. First, a total U.S. stock market index fund. This single fund holds virtually all publicly traded stocks in the United States, large, mid-size, and small companies. By buying this one fund, you are instantly diversified across the whole American economy. You are betting on the long-term success of American business as a whole, not the fortunes of a single company. But the U.S. is only about half of the world's stock market. To be truly diversified, you need a total international stock market index fund. This fund invests in thousands of companies across dozens of developed and emerging markets. This global exposure can smooth out your returns and provide growth opportunities from every corner of the globe. Stocks provide the engine for growth, but they can be volatile. To add stability, we introduce bonds. Bonds are essentially loans you give to a government or corporation for regular interest payments. Think of stocks as the accelerator in your car. Bonds are the brakes and suspension system. They aren't as exciting, but they provide stability and reduce the bumps in the road. For a young investor with decades until retirement, you can be aggressive. A portfolio heavily weighted towards stocks, with maybe 10% in a total U.S. bond market index fund, is a common strategy. This small allocation provides a cushion. As you get closer to retirement, you'll gradually increase your bond allocation to lock in gains and create a more stable portfolio. Now, what about major market trends, like artificial intelligence? It's a powerful and exciting theme. So, should you abandon our simple plan and start buying individual AI stocks? Absolutely not. For every successful company in a new tech wave, dozens fail. Trying to pick winners is a form of gambling. But here is the beauty of our diversified approach. You don't have to pick the winners because you already own them. Your total U.S. stock market index fund already holds the very companies building the AI infrastructure. By owning the entire market, you capture the upside of the entire AI growth theme without the devastating risk of choosing the wrong company. You get the reward without the gamble. This is the power of indexing. Your 3-step action plan. Open a brokerage account. Automate your contributions. Implement the 80-20 rule. Stick to this plan. You don't need to check it every day, every month, or even every year. You are building wealth for decades. Investing in 2026 doesn't have to be complicated. My strategy is secure your foundation, maximize tax-advantaged accounts, buy low-cost, diversified index funds, stay invested for the long run. If you found this helpful, hit that like button and subscribe for more straightforward financial advice. Now, I want to hear from you. What's the first step you're going to take in the comments below? Thanks for watching, and I'll see you in the next video.